Welcome to episode 46 of Let's Talk Bitcoin for October 1st, 2013. Visit us at letstalkbitcoin.com for our daily guest blog, all our past episodes, and of course, tipping options. We'll be in Atlanta for the Cryptocurrency Conference, October 3rd through the 6th. If you're going to be there, be sure to check out letstalkbitcoin.com/meetup and say hi. For those of you unable to attend, video conference passes are available at bitcoinvideopass.com. And of course, both streaming passes and DVD sets are cheaper when you buy with Bitcoin. My name is Adam B. Levine, and today we're talking about the realities of the situation. Falk Vinge, controversial author of Swarmwise and founder of the Pirate Party, has done the math and thinks the price of Bitcoin is off, way off, orders of magnitude off. Andreas explains his logic, and we talk about how value is relative and determined by what you want to get from your money. Then, I interview Benny and Emmanuel of Cloud Hashing, a hosted mining service that aims to give would-be miners instant gratification and positive return on investment for a nominal fee. In our continual quest to discover if mining is really suitable for anyone without at least 5 figures to invest, these guys hope you think they're the answer. Some of you love altcoins, some of you hate them. But the fact is that lots of different coins are offered up as donations to Let's Talk Bitcoin, and we wrap up today's show with a discussion about how we pick which ones to take versus not. But first, Local Bitcoins, for better or worse, is a high-traffic and influential source of in-person Bitcoin sales. Stephanie shares a recent story about what Andreas calls a cross-site scripting attack that drains your local Bitcoin's account of funds. Once again, I'm joined by Andreas M. Antonopoulos and Dr. Stephanie Murphy.
There was a scam recently on Local Bitcoins that was going around. And of course, Local Bitcoins is not free from scammers, just like anywhere in the Bitcoin world. But this was a scam that hadn't been really pulled off before. And what was going on was there was a user who was messaging sellers on Local Bitcoins and saying, hey, I have low feedback, but just to, put your fears at ease, I'm sending you a picture of my passport photo. And there was an attachment to the message. And now, first of all, that's pretty strange that somebody would send you a picture of their passport photo. If you're a seller on Local Bitcoins, you're probably not going to be doing the whole KYC thing and requiring a picture of government, 2 forms of government ID or whatever. So there's a red flag right there. However, some people clicked on the picture. And what happened was it took you to a very blurry looking scan of a passport photo where you couldn't see any details anyway, but it was meant to distract you from the fact that all of your Bitcoins on your Local Bitcoins wallet were being stolen. And what happened was this somehow, clicking on this picture, and I don't know exactly the computer sciencey details here, but basically what happens is if you click on this attachment, open it in the same window as your Local Bitcoins window, it executed a JavaScript that would initiate a withdraw from your Local Bitcoins wallet.
That's known as a cross-site scripting attack, or XSS. That's basically when software running in one of your windows or tabs is attacking software that's running in another one of your windows or tabs. In this case, the Passport JavaScript Trojan essentially is attacking the Local Bitcoins tab.
Right. So a lot of sellers on Local Bitcoins keep coins in their wallet on Local Bitcoins because basically from there, it's pretty easy to fund escrows that later, go into transactions. So it's convenient to have Bitcoins already loaded into Local Bitcoins for the purpose of trading. But in this case, this person exploited that fact. Now, there is a bright side to this. Of course, we can learn from this attack. Don't click on any attachments in Local Bitcoins, right? And watch out for JavaScript. Those are the 2 lessons I think that we can take from this. But Local Bitcoins has a security feature called 2-factor authentication, which you can use an app like Google Authenticator, which creates tokens that expire every 30 seconds. And in order to log in or to withdraw Bitcoins from your account, you've got to enter the token. And the token is, on another device, perhaps like your cell phone or something, or a different computer. And it's a little bit of a way to ensure that you are actually the person who owns the account and you're approving any withdrawals that happen. So in my mind, this is a big plus in the column of 2-factor authentication, and also just, being really careful and watching out for scammers and being super skeptical of any kind of attachments like that on a site like Local Bitcoins.
All right, let's try some advice for security newbies when it comes to Bitcoin. So first of all, advice number one, I think it's great to be careful, but it's very difficult to not click on things when you're on the web. So one of the ways I've found to protect myself against those kinds of attacks is to have my browser in essentially JavaScript denial mode by default. I run some software called NotScript or NoScript. On Chrome, it's called NotScript. On Firefox, it's called NoScript. And basically what this is a JavaScript whitelisting service. If you visit a page you've never visited before, by default, all the JavaScript, Flash, and other executable content is disabled. Only if you select to enable programming and code on that page can you see it. So that's going to break things like your online banking, which you can then selectively re-enable, but it's also going to break things like this cross-site scripting attack. Generally speaking, you do not go running around the internet without wearing some kind of prophylactic. And NotScript is essentially that. The second piece of advice, of course, is don't keep cash on these services. So online wallets suffer from this risk because the keys are not in your control and they're protected by a simple password. They're very easy to get out. So use paper wallets, distribute your funds between multiple services, try to keep it offline as much as possible. The third piece of advice is multi-factor authentication. Quick primer. Multi-factor authentication means using more than one way to authenticate yourself. Something you remember or something you know, which is a password. Something you have, which would be a token, such as a smartphone application, key fob, or something like that. Perhaps even a USB keychain. And then something you are, which is a third factor of authentication you can use. That would be a biometric like a fingerprint. Something you have, something you know, something you are, or as Chris Hoff puts it, something to beat out of you, something to chop off you, and something to steal.
Yikes.
So I am going to make a confession here. I am currently not using multi-factor authentication. I sort of made a decision that I just wasn't going to use web services. So, I don't keep money in anything online. And the thought has been that for the most part, that'll protect me. I also have paper wallets, of course, and things like that, offline backups, but I'm not actually using two-factor authentication. Andreas, do you think, given my particular use cases, I should be?
If none of these services have access to either your Bitcoin funds or your US dollar funds to your bank account, then really not a problem. As long as you keep the funds limited and you only fill them up when you're doing a transaction, it's not as good as using two-factor authentication, but actually I think it's a better solution than using two-factor authentication and having 100% of your money on online. I'd rather have 2% of your money on online and not use two-factor authentication.
So two-factor authentication improves the situation by making it so someone has to compromise two separate devices or two separate, vectors, as opposed to just being able to stumble across one, compromise that one, and take everything you have. I mean, that's the advantage. It doesn't make it impossible to have money stolen from you. It just makes it so that it's more complex.
It makes it so that the one factor that most people use, which is something the password. The problem is that can be very easily captured from a weak endpoint through a keylogger. The advantage of having a token like Google Authenticator is that it's much harder to break into that. And generally speaking, when you see compromises that involve two-factor authentication, it's because the service itself was broken. There was a bug somewhere else. Or in the last case we saw, it was random number generator generating poor quality signatures. But effectively, I don't think we've ever seen a service protected by two-factor authentication where somebody's had the second factor compromised. So if you use it right, it is secure.
There is a small cost to using it though, right? And that is that if you use two-factor authentication, it can take a little bit of extra time and effort. And it's not really as though there's like another password to lose, right? Because all you really need to do is be able to have access to Google Authenticator or your YubiKey or whatever, it's not really like there's another thing to forget, like a password, but it is an extra step. And so anytime you introduce an extra step, there's something else that could potentially go wrong.
Right, absolutely. Though I think what we're seeing again and again this lesson is that without two-factor authentication, money stored in an online account, whether that's Mt. Gox or Coinbase or local Bitcoins or any of them really, is not safe. And it's not safe because these companies are not doing a good job with security. They're doing a relatively good job with security. It's not safe simply because your computer is not safe, and no one can protect you against that except for two-factor authentication. So the problem here is that the endpoints are woefully insecure, and we've reached a point in society where we have invented a digital currency that can be stored on anything, but we haven't yet invented anything that can store digital currency securely.
Well, so this kind of brings us naturally into the topic of hardware wallets, which there have been a few. I think I've seen one powered by a Raspberry Pi, and I know that there's a concept floating around called the Trezor that actually is slated to ship at the end of October.
I've pre-ordered, and I'm expecting to receive 2 of those. As soon as I get them, I'll let you know.
So what is it that a hardware wallet does that is substantially different from it? Because a hardware wallet is not two-factor authentication. A hardware wallet is a distinct device that is only for Bitcoin and therefore can be treated as a secure environment, right?
Well, a hardware wallet could be two-factor authentication, or a hardware wallet essentially is a second factor in the authentication scheme. However, a true hardware wallet is one that processes transactions, so it signs stuff. It has keys on it. I think that's really the issue, is being able to store keys in a tamper-proof environment that can be controlled by the user. And usually when you have a hardware wallet, it has another factor, because, it's not the one factor is better than the other. It's the 2 factors are better than one. So if you have a hardware wallet, you still need a PIN or password to protect that hardware wallet. Otherwise, it gets stolen, so does your money.
I see. So it's just that the device in that case is a factor, and
Exactly.
the other. Okay, I see.
And the device is the something you have. And you need the second factor, which is something you know. And if it had a fingerprint scanner, you'd have a third factor, which is something you are.
So one of the natural things that comes up with either a hardware wallet or a second device used in a two-factor authentication scheme, what happens if I'm on a boat and I lean over the side and my phone falls out of my pocket and then my phone is gone? And that's my second authentication device. It's not like I can just load up Google Authenticator on another one of my devices. It was tied to that specific device, right?
Yeah, you're gonna have to go back and use the reset mechanisms on each one of those sites to reset the two-factor authentication system. And usually that will involve providing some other proof of identity. And so then it gets into the manual process, and it's not easy.
Do you think that this is, the direction that we're going now, where we're essentially adding additional layers to try and make it so that you can't just, get through one layer and be there? Do you think that this is the correct direction to go? Because I had a conversation with Jeffrey Paul a couple of months ago where he told me about Sneak's Law, which is that users cannot or will not adhere to operational security, basically, will not secure their computers because they either can't or they won't.
And that's absolutely true. So the way you resolve that is you take operational security and you weave it into the normal workflow or function that the user is doing, so that they don't know they're doing operational security. They simply do it. And I think in the case of these hardware wallets, what you're doing is you're making the two-factor aspect of it disappear into the background, because you physicalized the money and provided a second factor at the same time. So by hiding the security, we can get users to adopt it by making it a part of the normal interaction of money. So you apply the security without even knowing it. It's just part of the cultural norm or the protocol, if you like.
Well, I look forward to hearing what your thoughts are on the Trezor wallet once you get your hands on it, Andreas. That sounds pretty exciting.
Yeah, I'm looking forward to it. And what's interesting about this is that these devices are really enabled by this parallel revolution that's happening in amateur hardware, in the ability to take an OLED screen and a Raspberry Pi or a small microprocessor and throw together something like the Trezor with some 3D printing. I mean, you couldn't really do that 10 years ago. I think it's really exciting how those spaces are converging with Bitcoin.
Just as an aside here, Chris Abram just posted $287,859 refunded from BFL against their will to PayPal over the last 2 weeks.
Oh.
This week I was reading an interesting article from Falkvinge, and Falkvinge is the founder of the Pirate Party and pretty well-known libertarian freedom pundit, and he's writing about Bitcoin and the core underlying value of Bitcoin. And his basic premise is that Bitcoin seems to be vastly overvalued and partially caused by illegal price fixing. So his premise is that the current valuation of about $1.5 billion at about 100 and something per Bitcoin is actually vastly inflated and does not represent the underlying value of Bitcoin. And he bases this argument on doing an analysis of money velocity by looking at the transactional velocity of Bitcoin and looking at how these Bitcoin are being spent. I think the equivalent in Bitcoin terms is Bitcoin days lost, I think is the statistic that we see most often. So, based on his analysis, the bottom line is that Bitcoin should be valued at about $1.20 instead of $120. So he's saying it's valued 2 orders of magnitude higher than it should be, and that the real economy is only about 13 million US dollars, not 1.5 billion US dollars.
Isn't that speculation? I mean, like, isn't the whole price that Bitcoin has under it right now based on speculation?
I think that's really the argument that Falkvinge is saying. He's saying there is no market behind it. There is no transactional velocity to Bitcoin. It's really speculation. It's basically price fixing speculation more than anything else, without any underlying fundamentals. Here's the thing, though. He very conveniently excludes, right off the bat, drugs and gambling. So,
so the two biggest parts of the Bitcoin economy, no, they're not the biggest parts, but they're primary components.
They're significant.
I think he's talking about the relative velocity and liquidity of the market, and kind of dismisses drugs and gambling as illiquid, lacking in velocity, lacking in stickiness, lacking in true value. And then he goes on to talk about, what about normal products and services? And by the way, I am horribly paraphrasing and probably butchering his argument here. And obviously I disagree. But the bottom line is he's talking about the market being overvalued by 2 orders of magnitude.
I think that this is how markets behave. Markets look to the future and say, okay, well, it's not about what it's worth today. It's about what it's going to be worth later. And so obviously the price that we have now takes into account a lot of people who have bought with the idea that they're holding as an investment. So I think that it's hard to make the argument that it's not justified when so many people are using it as a means of saving. I think that savings has its place in a system like this, and it's not manipulation or speculation even, really. It's savings.
Well, yes. I mean, basically, I could take this exact article and do search and replace Bitcoin for gold. And based on Falkvinge arguments, gold has zero velocity because it's not really used to transact on normal products and services. And is entirely a store of value. So on his basis, I guess gold would be overvalued by 3 orders of magnitude, not 2. But does the value of Bitcoin really depend on the velocity? Because I think that's the assumption at the core of this article. And if you accept the assumption that the value of Bitcoin does or should depend primarily on the velocity of the currency, then yes, Bitcoin is overvalued. But I think that really reflects the fact that most people don't think that velocity is the only core value characteristic of Bitcoin, and that the savings effect, the future potential, the innovation premium, if you like, looking at it a bit like a tech IPO, all of those factors play into the price in a way that they don't in other traditional commodities or stocks or other types of assets.
I've seen a lot of articles in the past. It's kind of interesting to see Falkvinge writing about this, because I've seen a lot of articles in the past, including from people like Max Kaiser, who say, no, Bitcoin is vastly undervalued by at least 2 orders of magnitude, right? So maybe the truth lies somewhere in the middle, and that's what we're seeing right now in the current price. I mean, there's lots of people who say, oh, look at the amount of Bitcoins that there will ever be in existence, and look at the world population, and look at the percentage of the world population who are Bitcoin users currently, and the potential for new users, and suddenly you've got $10,000 Bitcoins for 1 Bitcoin. And the price of a Bitcoin is what somebody is willing to pay for it. We've said that over and over again on the show, and there are lots and lots of people determining that price every moment of every day through Bitcoin trading, buying and selling. And that's the current spot price, the market price. That's what the price is.
Part of trading on that price is reading articles by Falkvinge, deciding that you may agree with him and then selling lots of Bitcoin, or disagreeing and buying Bitcoin. So, Falkvinge is doing the job of adding more information to the market here.
Right, but most people, it seems like, either don't agree with him or there are enough people who disagree with him that it's holding up the market for Bitcoins at the current market price. Not enough to hold it up at $10,000 per Bitcoin, but some of those people, as we said before, are banking on that in the future, that Bitcoins are going to be worth $10,000 or at least more than 140 wherever they're currently at.
I'd love to think it's rational pricing that has put the price of Bitcoin at 125, but then I look at the Dow Jones Industrial Average at 15,000 and I know that people are insane.
You know that people respond to stimulus, and so that sort of brings up an interesting question. These yes, in both ways.
Was that a QE2 pun or QE4, wherever we're at now?
It was accidental, but yes, indeed. How we get the price in Bitcoin any way it goes is a total. It's like a black box, right? Because Mt. Gox has one price. When I was talking with Josh Rossi, he's talking about his Buttonwood software and how he wants to essentially collect prices from all of the Satoshi squares live that are going on, everywhere all the time, and also local Bitcoins, and use that as a way to aggregate and generate a spot price. Because really, with conventional markets, you have to use these broad measures. You have to pay attention to the entities like Mt. Gox because they're where all of the trading happens. But in a decentralized network, and especially a decentralized network like we have with Bitcoin, where regulation is constantly kind of spreading out. First off, regulation is doing it, and then also just companies failing under the weight of their own success, as we've seen with Mt. Gox. It seems like the market is almost anti-monopoly and is continuing to spread out, despite the fact that the incentives normally would have as large a concentration of traders on either buying or selling as possible. But here, that's not the case.
Well, here's the thing, though. Even if you look at these price fluctuations or price differences between the various exchanges, they all cluster around a midpoint and they all form a very beautiful bell curve over time. And I know I can't say with extreme accuracy what the current price of Bitcoin is, but I can discount, or rather dismiss, a overvaluation by 2 orders of magnitude, and I can dismiss that with a fair amount of statistical certainty. I can say, for example, that if all of these exchanges are telling us that the price is about 130, the chance of the price being $1.30 instead is 1 in 10 million. Simply by looking at the bell curve. You can do that calculation. You can see what the probability is. It's four standard deviations off the core. So, you can say there's uncertainty in the market and that there's price fluctuation in the market and price uncertainty, but it's not in the orders of magnitude we're talking about here. There's no chance of that.
So is this people picking their favorite reason? Because some people look at savings like hoarding. Some people look at hoarding like savings. It sort of is just semantics about how you're going to represent it. So is this people, is Falkvinge picking the thing that he most wants Bitcoin to be, which is transactional? Because if it's transactional, then that means it's ubiquitous. That means it's changing the world. Whereas if it's savings, then maybe that's not so true. So maybe he's just focusing on that. And to him, that's the only valid sort of reason why there can be value there, when in reality, Bitcoin as a protocol, just like the internet, is super agnostic and doesn't care what goes on. It doesn't care what you do with it, and frankly doesn't care what metrics you pay attention to it. Whatever metrics you're looking for, so long as it's something that's complementary with the overall protocol, you can find value for it or not in it.
Value is an emerging metric. It's not a core aspect of the protocol. It's something that emerges from the social behavior around it. At the end of the day, all of this analysis is trying to look at Bitcoin as an asset class and trying to figure out what type of asset class it is. Is it a currency? Is it a bond? Is it a stock? Is it a commodity? What exactly is Bitcoin? And the answer really is that Bitcoin is a cryptocurrency asset class. And we don't have analytical tools for figuring out the statistical value or the quantitative analysis that needs to be done in terms of the value of that market, because we don't have the tools.
Hello, I'm Jeffrey Tucker, Bitcoin enthusiast and host of the upcoming Cryptocurrency Conference in Atlanta, Georgia, October 5th. We've got a marvelously libertarian-infused day of discussion about what is indisputably the future of money, and you are invited. For those of you who can't attend, we've partnered with Let's Talk Bitcoin to offer video conference passes available for government currency and, of course, Bitcoin. For more information, bitcoinvideopass.com.
If I showed you a website where you could easily purchase electronics from the world's largest distributor with Bitcoins at 0% markup, would you think it was too good to be true? Good news. It's real, and it's at bitcoinstore.com. Choose from 500,000 items, save money over Amazon and Newegg, and convert your Bitcoins to real-world items. You can even buy with privacy. All they need is a shipping address. But don't take my word for it. See for yourself at bitcoinstore.com.
Over the last few months, we've been watching the network hash rate skyrocket as ASIC manufacturers ship overdue product to anxious customers. As the network passes the 1 petahash mark, we're joined by Benny and Emmanuel, two of the minds behind the Cloud Hashing project. Gentlemen, let's talk Bitcoin. So the first question that I have is there still an opportunity in mining? Because it seems like the cost of participating in that network is getting increasingly high, and the time frame to actually recoup your investment is getting even smaller.
If you allow me to take that question, it's Emmanuel speaking here. Absolutely. What we've seen is a bit of a shift in the usual mindset of miners, where they're used to ROIs in the space of 2 to 4 months, depending on delivery. We're seeing that shift towards latter end of a calendar. So depending on when you receive your hardware and depending on when you made the purchase, the network difficulty could have literally overtaken you. And in terms of is it profitable to mine? We'd say absolutely it is profitable. It's still profitable to mine. It depends on your strategy. It depends on your capital, and it depends on who you decide to partner with to be successful. If we look at what people have been doing in the industry as things stands now, people will be making orders from the 4, I'd say, major manufacturers. There are a few more coming online soon, and they would wait a period of 3 to 4 months. What our model is, and the way in which we've approached that, is to essentially use economies of scale to our advantage, so to purchase large amounts of hashing power and then to redistribute that to customers. So we will be probably one of the first companies to literally enable you to log on and make a purchase of hashing power and to be mining within 10 minutes. That's a complete shift from what the market is used to. And I think that's a model for years to come. Another thing as well is, people say, the money to be made in mining is within the first 2 to 3 months. Well, that is true, depending on what your model is. But also, if you have the ability to consistently or constantly add to the armory of your hashing power that you have, it gives you a much better stance to pretty much fight the network difficulty. And you can't do that as a solo miner. And that the whole market is going to shift. We believe mining belongs in the cloud, just as supercomputing does. And we've been pioneers in that field, and we believe it's pretty much the way to go.
So let's back up for a second here. Can you tell me how you got into the space, and if you've had any ventures in Bitcoin sort of things before? Have you been mining before you got into this cloud hashing business?
Oh yeah, I started off mining with my CPU when it was interesting. Then I got bored of it, then kind of left it alone. Then the GPUs came into business, and I gave that a bit of a go. And then my wife started getting a bit annoyed from the heat and the noise and the lack of spare room when people came to visit. So I kind of parked the mining project to the side a bit. Then when ASICs came online, I thought maybe I could venture there because the hardware was smaller, it was supposedly less noisy, and you could get more density out of it. But as time elapsed, more people became interested. So I began actually selling ownership of the machines to friends and family who were interested in Bitcoin, just to give them the ability to do so. So I'd manage they just had to pay the bills. So that was the initial cloud hashing model, and it birthed itself onto the internet in April this year. And we started selling contracts online, and the rest is history. We pretty much grew organically from running mining equipment in the bedroom to running an organization now who have 1,300 individual customers.
All right. Well, sounds like you've made some pretty fast inroads into the space. So let's talk about mining for a second. So the point of mining, I would argue, is to incentivize the distribution of the Bitcoin network to the greatest extent possible. But in a few years, in the few years that we've gone from 2009 to the point we're at now, that really hasn't been the experience. It seems like because we've gone so fast through the generations of hardware, it's been very difficult for people to keep up And essentially where, a couple of years ago you could mine with your CPU as you started out, now someone who wants to experience it for the first time just at that sort of curiosity level doesn't have anything like that, doesn't have anything near like that. I mean, so what do you think of, your service aside, what do you think of this trend generally speaking? And I mean, if you hadn't been able to access it in the way that you did, do you think that you would have started mining?
Yeah, I'll go into this a bit. The advent of CPU mining was essentially, as most people involved in Bitcoin mining are aware, to verify the transactions on the Bitcoin network and incentivize people to be connected to the Bitcoin network. The entry into that market was largely in the tech field in the beginning because the configuration of mining software was not exactly user-friendly, or ease of entry was quite high for the average individual that doesn't have background experience working from a console or something of that sort. And so in the beginning, people started developing GUIs to make it easier to begin to configure a mining platform software program. And then from there, it began to scale to more sophisticated tools and now monitoring tools and things of that sort. But it still has a large learning curve for people. And so one of the ideas that we had in the cloud hashing model was, how do we ease the entry point into mining and at the same time help people understand what Bitcoin mining is and why it's still advantageous to the Bitcoin network that people are mining Bitcoins. I mean, the incentive is there. People don't necessarily mine just because they're spirited to be miners. They do want to be rewarded. But the long-term plan for Bitcoin was that people were going to be mining because they're rewarded on the transactions that are taking place in the blockchain. So in essence, you are still incentivized in 5 years, 10 years time. And to get into that market as an individual that is looking to get familiar with mining and jump into it, it's not as simple as just go download a program and start running it on your CPU if it becomes quickly evident that there's no reward there for you. So we wanted to make it possible for people to understand that the reward is still there. You just have to be able to see how to get to it. And so the cloud hashing design is to be able to bring a person into mining, show them that there is an estimated ROI that is potential, and then that there's a difficulty that you're running up against. And so we're trying to make some of this more transparent to people that are walking into this and going, oh, mining, this makes sense. It just, throw some machine on and I should be making money. Well, with the cost of power versus the difficulty rising and the amount of equipment you need to overcome those costs, we believe that there's a scalable model that can work. And we've implemented that into the business model of cloud hashing to benefit the customers. And ultimately, we have a goal of benefiting the Bitcoin network alongside that.
It seems like one of the biggest challenges that you run up against in mining, however you're going to do it, is not necessarily the fact that the difficulty is going up so much as it is how you're timing your purchases relative to the rest of the world's release schedules. Because now there are several manufacturers in the space. Yeah, so if you get a whole bunch of hashing power at the beginning and then 2 days later there's a giant release and you're suddenly swept away. So how have you been able to to counter that risk?
Yeah, to some extent, we were absolutely affected by those risks at the advent of the company. We made substantial orders of equipment that, we were waiting to be delivered, and, customers were obviously were frustrated by the delay. So being a cloud company and being able to have the capital and the liquidity to go onto the open market, we're able to still service our customers because of the skill that we have. Now, in respects to individuals having to make those kind of purchases and waiting 3 to 4 months where the ROI literally dwindles away. Now, we believe that model will die out because people might not be able to stomach the risk. There's a lot of money has gone into pre-orders, and a lot of people are still waiting for delivery, and a lot of people have lost money, and a lot of people have been dissatisfied with how it's been handled and might not even play again. The model we're offering is very different. So we essentially are the kind of orders we make it gets people's attention. It gets the attention of the manufacturers, so you can work closely with them to ensure that customers are not burned by those kind of delays. I mean, if you're an individual making an order, through the website, you'd be treated differently from if you're a large organization looking to have a long-term business relationship to pretty much service your customers and at the same time benefit the manufacturer. And I think the manufacturers themselves, they would prefer to deal with larger organizations rather than loads of customers constantly getting back to them. Oh, my ASIC doesn't work. Oh, the power unit has blown up. How do I sort this out? And those kind of issues would pretty much be dwindled away if you just took it to the cloud. They'll be dealing with one entity, actually 4 or 5 entities instead of the many. And that's how we've mitigated our risks. Pretty much working with the manufacturers ourselves directly, and pretty much being in the know of the project scope and any potential delays, so that we can adequately make alternate arrangements for any delays. So that's kind of where we are now, and that's we're seeing that mature as a model.
So do you basically have units standing by, and so when people buy them, then they just switch over to their account instead of crediting you? Who I assume you're running them yourself when you don't have customers to run them for, right?
Yeah, the way in which we work. I mean, I'll give you a small background of our model without selling. We will purchase large quantities of ASIC hardware. We will put them in data centers, and the data center would have an agreement with us to manage them, or we have our own person to manage it, depending on which city it's in. Now, the equipment will be mining constantly. Now, a customer would go through our website, would make a purchase for hashing power. Now, from the 30th of September this year, as soon as they make that purchase, within 10 minutes, they would be manning automatically, because that hardware is already available, it's already there. So there is no delay, there is no pre-order, there is no wait. It's instantaneous, and that's what people are used to in the cloud space. They're not used to making a purchase and waiting 3 to 4 months, or not given a definite time for delivery. They're used to making a payment and getting what they've paid for instantaneously. That's the model that we've switched to, and that's the model we believe it's palatable for the mass market. Now, and another thing is, regards to difficulty increases, how do you deal with customers worried about the the bi-weekly difficulty increases, and how do you pretty much keep them motivated to mine, and also keep them motivated to that they know that they're actually going to get an ROI? What we do is we'll essentially only sell up to 60% of any capacity that we have. At the end of each month, what we do is we purchase on the behalf of the clients the hashing power that we have as a reserve, so that they get an increase in hashing power, so that it allows them to either stay in line or at least not feel the mass effect of the difficulty on their returns. Now, that's a better model than sitting on a piece of hardware that every 2 weeks the returns are dropping by 20-30%. So that's the model we've adopted, and that's the model the market will be used to. So that's what we've worked out with talking to customers, pretty much getting an idea of the kind of things that pretty much take them off, and trying to adapt to the needs of the customers on that front.
So I'll also comment on the network hash rate unpredictability that a lot of miners are seeing. This is clearly a risk that miners are taking when they're buying hardware on the market that has the pre-order basis. We've often said to people that it's a lot easier to look at the network hash rate to determine what your potential return is, because the network hash rate is in flux on a constant basis, whereas your difficulty changes are built into the algorithm of the Bitcoin design. And so if you're in the know in terms of researching and discussing and finding out what the supply chain challenges are of various manufacturers, it's a little easier to predict what the network hash rate might look like at a certain point in time in a given period. Now, we don't know in a year from now, but we might be able to say in 3 months, based on these companies, we can somehow gauge that the network hash rate is going to be between X and Y. And then if we say that your hash rate with cloud hashing is this, and that based on our model, the hash rate of your account will increase based on the estimates of the network hash rate increasing in a proportionate way, you have a way of being able to calculate with some degree of accuracy what your ROI could be. Now, we don't know if a company is going to come out of the left field that no one's heard of and dump an enormous amount of hashing power onto the network, perhaps a ASIC manufacturer that nobody saw coming. That's always a possibility. There's nothing anyone can really do to prevent those kinds of things happening except for be prepared. And that kind of preparation that we take is in the accumulation of good business partnerships with ASIC manufacturers that want to support not just us, but the fact that we are redistributing this hashing power to the customers. This is a really key point in one of the reasons why ASIC manufacturers have worked with us so closely, because they believe in the business model that we have. Sure, there's a lot of companies that just want to make a profit. There's a lot of individuals that just want to dump a lot of money into mining hardware and immediately mine for themselves. We get that. We understand that there's always going to be that market out there where there's people that are very bull on the long term of Bitcoin. They'll put money into mining and take the risks. But the attitude that our customers have is that cloud hashing is going to support them, and that the manufacturers are going to support cloud hashing, and in turn, everyone should benefit. We found that the manufacturers that understand our business model want to keep our customers in line with the network hash rate increases as much as possible. Reason being is that, like any manufacturer, your goal is not to sell a product to somebody once, it's to sell a second and a third and a fourth time. We believe in the same model. We want our customers to be return customers, repeat customers. We want them to tell their friends that this is working for them. So for us to just sell one contract to one person is not our ultimate goal. We want people to believe in the model and understand that there is a long-term benefit to cloud mining, and that it actually has a benefit to the Bitcoin network, because what we're doing is making it possible that one or two or a small group of individuals do not have all of this mining power for themselves. As a result of that, more people are involved in Bitcoin. It's distributed as a currency to more individuals out there, and hopefully that will help the Bitcoin network thrive.
Okay, I have a couple of questions off of those two answers. First off, is the increase of hashing power standard, or is there a cost associated with it?
The way the model works is we essentially, the customer would make a payment for the contract. In the contract, we specify the two different costs associated with the contract. So one is a management fee, then the other is a reinvestment. So we essentially enable the customer to make a payment of up to 30% of whatever the mining revenue is. We're soon going to allow that to be variable. Make a payment of what they want to reinvest in hashing power, and that would automatically be deducted from the payouts. So that would then go into hashing power at the end of each month. So if they made $100 and they've set it to 30%, they would take $30 and use that to buy more ASIC hashing power for themselves.
I'm just wondering if there's what the ratio is there, because it seems like, as someone who might be interested in one of these, I'm trying to figure out if that actually is even something that it would be beneficial for me to pursue, because 30% of what so 30% would be buying you more than just taking the payment would be?
Oh, absolutely. The price that you'd be paying with the reinvestment is a lot less than you would be paying with a contract. So there's a massive benefit there. So if you bought in at the one thing people need to be aware as well is there's a massive increase in hashing power, but also the cost per gigahash is dropping. So if you look in January, we're looking at costs down by maybe 80% per gigahash. So we can either buy in the future on behalf of the customer. So maybe in 3 to 4 months' time, they would get multiples of what they started with as a miner. Now, how would you do that as an individual mining? And how could you ensure that you have the hardware on the day you want the hardware to start mining without making a loss? You couldn't do that as an individual unless you had a lot of capital and a lot of patience. So doing it in the cloud gives you that benefit because it's managed on your behalf.
One of the things that allows industry to scale is to have a lot of people backing that industry. And we looked at that as part of how the model has to integrate. When we designed cloud hashing, we realized something that was very critically important, and that is that it's not all about how much hashing power you have. The number specifically isn't that important. It's about how many people are part of something that are collectively working towards a goal. And because the cloud hashing customer base is well aware that when they sign up, this is something that they're signing into, that it is a collective initiative in a sense to be able to increase the cloud mining capacity for the benefit of all customers. So even though it's 30% as an individual, that 30% goes a lot further than that same 30% that you would be taking in as an individual miner, and then hopefully taking that money and then putting it towards, say, your next purchase of an ASIC when you reach the ROI point that you can now afford your next one. So on your behalf, every month this increase is taking place. It's adjusted in your hash rate in our system. It's visible to you as a client, and you're immediately mining with that adjusted hash rate as soon as it takes effect. So whereas as an individual miner that's buying hardware, you're actually sitting and waiting for that hardware to reach a ROI point where you can now go and buy the next thing. With us, 30 days later, or however, maybe less, you have immediately taken some additional hash rate and put it into your account, and now you're mining with that. And this is the ability to scale with the network hash rate increase better than waiting on the next hardware to show up at your doorstep.
So I hear the decentralized argument, and I think that I agree with you on the decentralized argument, but don't you as the service provider actually control all of these? It seems like people aren't actually mining, they're more the recipient output. You know, like instead of it going to your wallet, it goes to their wallet. So isn't there a differentiation? Do they choose like what pool they participate in, or is there any control?
Well, I'm glad you asked that question. Well, one of the things that will be rolled out here with the next September mine is the cloud hashing technology, which is going to offer a pool technology to miners in a very innovative way. It'll be the first mine that we're aware of that allows people to both mine in the cloud based on the cloud hashing model, as well as allowing those customers, as well as others that are not customers of cloud hashing, to mine through the cloud hashing mining portal. And that will essentially make it possible for anybody that wants to mine within the cloud hashing cloud, you might call it. I'm kind of dropping the cloud word a lot here, but allows people to access this cloud and be able to participate in it as well. And on the topic of decentralization, one of the sticking points that has been often debated is what makes it decentralized. If you were, for example, a large pool, and we've seen this out there with other mining pools, what happens if you reach 51% of the network? There's a very common concern amongst miners out there about the 51% attack potential that a mining operation could achieve if they had so much hashing power that they could overtake the network and do what they call a double spend. One of the technologies that we're implementing into the mining design that makes this very advantageous for the technical miner is the ability to select transactions that a person wants to mine within our system. This is something that we haven't seen out there done before by other mines, and this allows people to select the transactions and, in essence, makes it a truly decentralized model from the outsider connecting to our mine, which means that, in essence, a 51% attack would be highly unlikely, if not next to impossible. We're taking the power away from ourselves and putting it in the hands of people that are connecting through our portal. So it's become very commonplace now that we're often asked by customers and engaged by people in general conversation in Bitcoin about these Bitcoin mining calculators. For example, one of the more popular ones that has become almost a staple in conversation as of late is the one on the Genesis block, which is the mining.genesisblock or the genesisblock.com. And they have a mining dashboard where they are allowing you to look at a matrix of all the different manufacturers and their hardware and their costs and so on. What these tools are essentially designed to do is give a person a perspective on what their potential ROI is. What these things fail to do is give a person a perspective on what changes based on new hardware being introduced on the supply chain basis that we talked about. The miners have just a few fields to fill in, and suddenly they're able to predict based on these calculators what their ROI is, it's a little deceptive to people because what your ROI is largely based on your scalability, not just based on the fact that you can plug in a number and that the network is going to scale based on X, Y, and Z. The Genesis block, for example, shows the average over some period of time of difficulty increases and then comes up with a prediction of the in the next month or the next couple of months over what they believe will be, some period of time. Well, there's also a supply chain aspect to making that even a probable possibility, you should say. You can't continually increase the network over and over and over again without having some pretty massive supply chain issues that will be hard to overcome for all manufacturers once the network reaches a certain size and the difficulty reaches a certain size.
Can I also add to that? There's also the economics aspect to that in terms of if we're talking about the network being at 15 petahash, for example, or 20 petahashes, how many millions of dollars will need to be spent to cover the difficulty rise of 80%? When we're talking about a 51% style attack every 30 days or so. And on top of that, we're talking about, an infinite amount of money being able to be thrown into a market. Right now, there's worth 1.4 billion. I'm talking about the Bitcoin as a whole. I'm not even talking about the mining market. That's probably, $100 million, who knows, maybe less, So it's not, I don't think the tool is meant for exact calculations of what hashing power is. It gives people an indicative figure, but at the same time, it's deceptive because people don't know what other factors are necessarily going to affect the growth of a Bitcoin network. I mean, for example, if we're going to have consistent growth in the 50s, above 50%, we're going to need new technology, maybe 14 nanometer technology that costs $16 million just to get to the foundry, and to even make an ROI. How many millions of dollars more do you have to sell? So things like this haven't been thought of, and I think it's people need to be aware that just plugging into a Genesis block is not a sure thing to say that you will not make a profit or you will make a profit.
Do you think that this is a one-way trip for us and that the difficulty at this point, because there are so many players involved, can only go up? Or do you think that the price actually is going to play a role at some point and that the price actually needs to go up in order for mining to continue to be profitable?
Well, price is always a thing. There are three things here. One, the cost of electricity. So if you can get electricity dirt cheap, then you could mine with, if you mine with the best equipment and you get electricity really cheap, then you could run your hardware as long as humanly possible compared to having another piece of hardware that's less efficient in a state like California where you might not get the best energy rates. So, that's one aspect. Your strategy could be based on, a long-term strategy where you could see that you just essentially want to hit your ROI based on what it's costing you to run. Then there's another model of, let me make as much money as I can in the next 3 to 4 months, buy as much hardware as I can, make my ROI and go home. The rest of the other model is kind of like our model is, see it out for the next 2 to 3 years, make your money back, try and spread it over a 3-year period so that at least you can benefit from any rises in that window or space. I do believe everything is going to be controlled ultimately by price. If Bitcoin does not get adopted, then we're mining for no reason. If the adoption continually grows, then we're going to see higher and higher prices of Bitcoin, and then that would even price has an effect on mining. So you find suddenly people that turned off maybe their ASIC that's decrepit a year ago would now decide to turn it back on, or the FPGAs or the GPUs, just because it's costing more than electricity just to run. So we're going to see, volatility in the difficulty. We're going to see volatility in the hashing power coming onto the network based on prices. And we hope prices will go higher, and we believe it will, because adoption ultimately is a goal. And we're seeing greater and greater adoption in other countries where aren't actually talked about in a lot of the news.
Benny and Emmanuel, if someone wants to learn more about cloud hashing, how should they go about it?
Just simply visit cloudhashing.com. We have an intuitive video that gives you an intro to the concept of cloud mining, and hopefully it makes sense. And if you have any questions, just drop an email to info@cloudhashing.com. We'll be happy to help.
We'll check in with you in about 6 months and see where the hash rate is. Thanks for joining us on Let's Talk Bitcoin.
Thanks, Adam.
EasyDNS is the Swiss Army knife for your domain names, helping meet their customers' individual needs since 1998. EasyDNS has been an outspoken critic of SOPA and CISPA. EasyDNS was an early supporter of Bitcoin, and now they are proud to sponsor this show. Do business with a company that shares your values. Get a 13% discount when you pay with Bitcoin. Go to bitcoin.easydns.com and be sure to use discount code LTB. You're listening to Let's Talk Bitcoin, the premier audiocast providing news and insights that cover the rapidly evolving world of digital money. Our twice-weekly shows include analysis of late-breaking news, updates on key technical, business, and regulatory issues, and in-depth interviews with the key people driving the new digital economy. Let's Talk Bitcoin offers sponsors an attractive way to reach a targeted and savvy audience. For more information, email sponsors@letstalkbitcoin.com.
So, guys, we have to have a meeting about this because I've been trying to figure out how to proceed, and it's really hurting my brain. I got an email from, I don't recall his first name. His last name is Franco. He's the creator of the Franco coin, basically. And he has let us know that he wants to donate to us in Francos. And so I looked into his currency a little bit. It's derived from Litecoin, except it has a fewer number issued than actually even Bitcoin does. I think it has half the number issued that will ever be issued of Bitcoins. So in theory, it's going to be quite rare, and it has a very fast transaction time. It has about 30 seconds per block. And so I emailed him back and asked, what advantages his currency has that would make it so we should want to accept it, besides the two technical differences that he had done. And I haven't heard anything back from him, but it kind of has brought up a larger point. We get these requests sometimes from people who have alternative cryptocurrencies, and I don't really know what standard we should be setting for when we should accept something for donations for the show. Because on the one hand, they're not really buying anything from us and they want to donate to support what we're doing. But on the other hand, it's definitely a marketing move on their part where they want us to say we accept this, because then that adds to the utility of theirs. So it's not like it's a selfless thing. So I'm wondering, when you guys are looking at what new alternative cryptocurrencies to pay attention to or to set up a wallet for, what are the criteria that you use?
That's such a great question. I wish I could say I actually had some hard and fast criteria. It's more like I have to see it become a blip on my radar more than a couple of times. I made a fortunate investment in Litecoin about a year ago, which ended up doing really well. But I'm kind of skeptical about a lot of the other cryptocurrencies, especially since now there are so many of them. And an altcoin really has to differentiate itself to stand out in the current climate. And, I just don't know if we're at the point where that's really likely to happen yet. And I can't see like the clear leaders in the pack. So I haven't been super buzzed about altcoins lately, except for maybe Litecoin, because it seems to have cleared a certain bar. As far as accepting donations to the show, I wish there was an easy way to have a multi-currency wallet. I know people are working on that, but I don't know of one that exists yet, because if we could have that, it would be easy to administer. We could just have a wallet, and when some Franco coins come in, we'll see a little notification, and we could do basically whatever we want with those Franco coins. Spend them, save them, give them away, whatever. Convert them to Bitcoins, whatever we want. We're just not there yet.
This question that you're asking, Adam, is the same question that plays out thousands and thousands of times. Every time an altcoin comes up for any buyer, any seller, or any user. This is the fundamental adoption question, the balance between the network effect, convenience, and existing value of Bitcoin versus the value of an additional coin. And in that, you have to balance out the network effect. As I said, you have to balance out the adoption difficulty, the technical difficulty of charging in multiple currencies. You have to balance out the foreign exchange risk of converting it, how convertible it is, what kind of liquidity there is in the market in order to convert it, how many access points there are. You have to look at the history of the currency and how stable it is in terms of fluctuations, or also in terms of mining difficulty, because that's another aspect of cryptocurrencies that plays a term in stability. So all of these essentially compromises or trade-offs happen in the mind of any consumer who's deciding between Bitcoin and another currency. And I think all of this goes to demonstrate why it is so difficult to unseat the king of cryptocurrencies, why it is so difficult to say, I'm going to go with a completely different alternative. And the reason is that it has a lot of cost to do that. And so as a result, it has to have a really compelling reason. And quite honestly, I don't think you have that.
But does that mean that they don't have any value? I mean, I don't think so. I think there could be
have dust value.
Yeah, they have dust value, but I don't know. There's a part of me, I know I just said that I'm not like super, super excited about any of the altcoins, but there is a part of me that kind of sees like, okay, like, yeah, there's some, Prime Coin, like it's finding prime numbers, and PP Coin has got the proof of stake, and Feather Coin has like great promotion, and that might be interesting. And so at times I do feel excited about altcoins, and it doesn't hurt to diversify. If somebody wants to give us some pick your favorite coin, then I don't really see the problem with that. Maybe it feels like a headache because we're kind of trying to decide, well, what do we actually think about all these altcoins? Is this going to require me doing research on them? And do we convert them to Bitcoin and essentially cash out, or do we hang on to them? And that decision feels overwhelming, and we just don't want to deal with it. Could that be sort of what's going on?
Oh, it's enough to make that decision with Bitcoin.
Right.
We're running multiple shows just to decide whether we're holding Bitcoin or what even the value of Bitcoin is. I think then multiplying that by a whole set of other coins, it can really be a huge headache for merchants. So it's easier than adopting multiple fiat currencies, but it's not as easy as just having one.
So I see a couple of options here for how we could push forward on this, because Stephanie, to your point, I think it really is a usability thing. When I installed the Feathercoin wallet, because we had a listener who wanted to donate to us in Feathercoin, that was the fourth wallet that I had set up on this particular computer. And before that, in addition to that, I had Primecoin, which I was playing around with because I was trying mining with it, actually, which was quite interesting. Bitcoin, Litecoin, and then Feathercoin. And when I set up Feathercoin, I actually had problems with my computer. Not that it was a problem with Feathercoin, just that that was apparently the number of wallets that my computer felt comfortable running and the number of blockchains that it felt, So I really think that so long as you need a separate installation for each new cryptocurrency.
The feather that broke the camel's back. Sorry.
Yeah, exactly. Yes, exactly. So, when I run 3 of them at once, it's all fine. But when I run 4 of them, I tend to get some instability in my system. So I see a couple of ways forward on this. I can either see setting up like a bounty system where we have a minimum value threshold where people can send their whatever coin it is to an escrow address that we have set up. And at the point that we, reach whatever the threshold is, say it's like 1 Bitcoin worth of whatever the altcoin is that we're talking about, then we go to the trouble of setting up, a full wallet for the show and doing all that stuff. Or I could also see us partnering with, or it being a service that's provided by an exchange like Vercurex, where they're already dealing with all of these altcoins, and they deal with a lot of altcoins. And as a result of that, they could essentially give us an application that would let people send something to a show account that would be able to be denominated in any of those things. And then we'd have the ability to change it into other cryptocurrencies or keep it in that, but not have to maintain all of the wallets on, a series of actual computers that we have to control.
Right, because the exchanges right now, like BTCE or Vercurex, they do sort of have multi-currency wallets, like where you can log in and see your finances, and it has a wallet for each of the altcoins that's on that exchange. And people, you can send funds to it or whatever, and then you can easily trade because they're already in the exchange. I guess I see a problem with storing the coins on an exchange because that's basically a web wallet and they're vulnerable to hacks. But I really like the idea of hey, let's have an address for each of these coins once we reach a certain threshold. And I think 1 Bitcoin equivalent of those altcoins is a good threshold to have. Then we'll put that up as a donation address. I'm all for please, if somebody wants to give me money, I would like to make it convenient for them to do that. You know what I mean? If somebody wants to support Let's Talk Bitcoin, let's make it easy for them to do that in whatever way they want to, So I'm kind of erring on the side of, let's put up an address for every coin. But I realize, that might look a little bit cluttered potentially on the website.
I don't even think it's a problem with the cluttered look. I just think that But there are so many of these currencies that are going to fail because they don't have very many fundamental advantages to them, and they don't have, you need something. It almost doesn't matter to a certain extent what angle you're going to approach the problem of cryptocurrency from, but you need to do something that is different, be it how you market it or be it how you, the innovations in the currency fundamentally itself. You still need to have those differentiations. And I feel like a lot of the currencies that are out there, it's very difficult to make that claim to. But I mean, even beyond that, I just don't think that it's workable, Stephanie, because we're talking about, there are more than 150 cryptocurrencies out there right now. And I have to imagine that that's going to continue to expand.
Right. Absolutely. But I mean, we're only getting donation requests for maybe 10 of those, right?
Right now, right now, while we accept. So, and this, of course, brings me to the other part of this conversation. So we started accepting Litecoin donations, I guess, about 3 months ago. And the first couple of shows were pretty successful. And, I can look back and actually show 11 and show 13 were two of our highest tip shows because we got single donations of 100 Litecoins to each of those shows. And so that actually was more substantial than the Bitcoin donations at that point. But since then, we've had, we get probably between 0.5 or 1 Litecoin per episode on a good episode. And sometimes we don't get any Litecoin. So the question becomes, how, is there a minimum threshold beyond which we should, not be generating? I should not be spending the time to generate the addresses and to to run the client if we're just getting these small amounts Should there be a minimum threshold?
Well, maybe we don't have an individual Bitcoin, Litecoin, Frycoin, PP-Coin, every single coin address for each show. Maybe we just have a general show fund for the altcoins that are not Bitcoin or maybe not Bitcoin and Litecoin. You know what I'm saying? Maybe we
can have 3-dimensional wallets. I mean, essentially, the bottom line is that all of these coins at their core use the same elliptic curve cryptography system for the public and private key. The only difference between a Bitcoin address, a Litecoin address, and a Feathercoin address is what prefix you stick in front of the address before you send it out. So you can take a single private key, and from that you can generate a public key, which is a point on the curve for Litecoin, and code it for Litecoin. And then you can take the same key and encode it for Bitcoin, and the same key and encode it for Feathercoin, and the same key and encode it for PP-Coin. And so essentially what you would do is you would have one wallet with one private key that unlocks all of the public keys of all of the other coins. So I think we're going to solve this problem over time, and the default will be multi-currency systems.
So when can I have that?
Well, I wrote a prototype implementation, works on top of BIP32, but unfortunately, turning that into a business, we need one of those opportunistic entrepreneurs.
Yeah, I just Googled that multi-cryptocurrency wallet, and I found a thread on the Bitcoin forum that was suggesting some software for Windows. And then the next post was, yes, complete with wallet stealing Trojan free of charge. So we're not there yet.
That's by the way, that's one of the disadvantages, right? If you solve the key management problem by tying all of the keys to a single private key, then if you lose that one, you lost all of them.
Right. Well, Adam, maybe what we need is a altcoin enthusiast treasurer for Let's Talk Bitcoin, and I would be happy to be that. Why don't we just have everybody send their altcoins to my wallet on Vercurix, and I'll be the administrator of that.
Okay.
No, I'm just kidding about that. But
ultimately, if it's not you doing it, it's me, Stephanie. So I mean, it's yes, to a certain extent, there's a little bit less trust, I guess, but it doesn't really matter.
Yeah, I'd like to also start considering taking other forms of payment as well. So I will be the treasurer for beer and pot, and I will convert those in my digestive system.
Thank you, Andreas. Thank you very much.
Welcome.
Has anybody, actually, that's a great point. I mean, has anybody ever offered to donate physical stuff to Let's Talk Bitcoin, or like maybe other things like gold or silver or stocks? Or, I mean, I know some organizations have offers of those, but we're having the problem where, hey, take my altcoins, right?
Yeah, no, we haven't. There have been no physical offers yet. It's been altcoins. And again, the other thing about the altcoins, of course, is that it's not just a donation. I mean, like, it's a donation because they want to donate to us. But they want us to care about the cryptocurrency. I mean, that's the fundamental thing. It's not like they're donating because we're the best people in the world. They're donating because there's an advantage if we get interested in it and start talking about it with our audience.
You mean like spending 10 minutes talking about Franco coin that does ADD blockchain confirmation every 30 seconds? Yeah.
Exactly. So, so there's a really fine line to walk here, I think. I'm just not sure how to approach it yet.
Well, I don't know if we've resolved anything with our on-air meeting, but it's a good problem to have, right? I mean, if people are offering us donations, like, yeah, that's great. Even if there's strings attached to it, even if they want us to promote their coin or whatever, okay, fine, I'll take your money, right?
Fair enough. I mean, this is a problem. I mean, that's the fundamental part here, is that this is a problem. And Andreas, whether it's solved in the manner that you described or whether it's solved in a manner we can't even conceive of here, I think that it will get solved. And that makes me feel good.
That's the beauty of frictionless currencies, right? Because the fact that all of these coins have very low friction and are very fungible and very easy to transport and trade is what makes them very easily transferable or convertible from one to the other. So, the advantage is that unlike the enormous friction we have converting fiat to Bitcoin and back, converting Litecoin to Bitcoin, Freecoin to Bitcoin, that's easy. So, one of the advantages, what we're seeing here, this proliferation of coins, is also really a symptom of the fact that you can convert them more easily, so it's easier to adopt.
Thanks for listening to episode 46 of Let's Talk Bitcoin. Content for today's show was provided by Andreas M. Antonopoulos, Stephanie Murphy, with Benny and Emmanuel from Cloud Hashing. This episode was edited by Matthew Zipkin. Music was provided by Jared Rubens and Jazztown. If you can't get enough original thought and discussion, read our daily blog at letstalkbitcoin.com. Sign up for our weekly newsletter at theweeklybitcoin.com. To get in touch, send me mail directly at adam@letstalkbitcoin.com or visit letstalkbitcoin.com/talk to be directed to our listener subreddit. See you next time.